So, you're thinking about buying a home. Awesome. But let's be real, the whole mortgage process can feel like you're trying to solve a giant, complicated puzzle, right? Well, today we're going to dump all the pieces out on the table and show you exactly how they fit together. We're here to turn that confusion into confidence and give you a clear map to your new front door. Here's how we're going to do it. First, we'll talk about getting prepared, the starting line. Then we'll get into the numbers game of your budget. After that, we'll explore all the different loan options to find the right fit for you. We'll even walk through the application itself and wrap up with the key rules that are there to protect you. Sound good? Let's jump in. Okay, first things first. Preparation. And I can't stress this enough. This is probably the most important part of the entire journey. Getting this part right sets you up for a much, much smoother ride later on. To really get prepared, you have to learn to think like a lender. So let's ask the big question. Before you even start daydreaming about houses on Zillow, how is a lender looking at you? It all boils down to a process they call underwriting, which is really just a fancy way of figuring out how much risk they're taking on. And they use a pretty simple framework to figure that out. The 4 C's. First is capital. That's just the cash you've got saved up. Second is capacity. Can your income actually handle the monthly payments? Third, and you knew this was coming, is credit. What's your track record with paying your bills? And finally, collateral, which is just the house itself. Every lender is just trying to answer questions about these 4 things. So let's see how those 4 C's translate into your actual budget. This is where we get into the nitty-gritty, the numbers that decide not just if you can get a loan, but how big of a loan you can actually afford. And the most important number in this whole game is your debt-to-income ratio, or DTI. It's actually pretty simple when you break it down. A lender takes all of your monthly debts, your car payment, student loans, credit card bills, adds in what your new mortgage payment would be, and divides that total by how much you make each month before taxes. That little percentage tells them everything about your capacity to take on more debt. Now, here's where it gets really interesting. That DTI limit isn't the same for everyone. As you can see, a standard conventional loan likes to see you around 36%. But a VA loan gives you more breathing room at 41%, and an FHA loan might stretch all the way to 43%. That small difference can be a really big deal, and it's often what pushes a buyer toward one type of loan over another. The other big ratio to know is loan to value, or LTV. Honestly, it's just the flip side of your down payment. So if you put down 20%, your LTV is 80%. It's that simple. All it means is that a lower LTV is less risky for the bank, which is always a good thing for you. And this number becomes super important when we talk about mortgage insurance. All right, now for the main event. We've got the budgeting basics down, so let's dive into the different kinds of loans out there. It's time to figure out which path is the perfect fit for your specific situation. This chart is a fantastic cheat sheet. You can see the big differences right away. Conventional loans, they're really for people with strong credit. FHA, way more flexible. And then you have VA and USDA loans, which can get you in the door with zero. That's right, zero down payment. But they're for very specific groups. Let's break them down one by one. First up is the conventional loan. This is kind of the bread and butter of the mortgage world. It's not backed by the government, so it's the go-to path for borrowers who've got a good credit history and have managed to save up a bit for a down payment. Now, a huge part of conventional loans is something called private mortgage insurance, or PMI. Here's the deal. If you put down less than 20%, so your LTV is over 80%, you have to pay this extra insurance fee every month. But, and this is a big but, it doesn't last forever. Once you've paid your loan down to that 80% LTV mark, you can actually call your lender and ask them to remove it. And even better, by law, they have to automatically cancel it once you hit 78%. Next up, we've got the FHA loan. This one is insured by the government, the Federal Housing Administration, which makes it a fantastic option for people who might not quite qualify for a conventional loan. Maybe their credit score is a little lower, or they just haven't been able to save up a big down payment yet. But of course, there's a trade-off. FHA has its own kind of mortgage insurance, called MIP, and it's a bit different. First, you pay a big fee up front, 1.75% of the loan amount. Ouch. Then you also pay a monthly fee. Now here's the kicker. If your down payment is less than 10%, that monthly fee sticks around for the entire life of the loan. It never goes away unless you refinance. Our third path is the VA loan, and it is an absolutely incredible benefit for those who've earned it through their military service. It's guaranteed by the Department of Veterans Affairs, and that guarantee opens up some truly powerful advantages. And this, right here, is the biggest advantage of them all. Zero. That is the minimum down payment for an eligible veteran on a VA loan. This is an absolute game changer, making homeownership possible for so many service members who otherwise would have had to save for years. So, how can they do that? Well, there's no monthly mortgage insurance on a VA loan. Instead, most vets pay a one-time funding fee that just gets rolled into the total loan amount. And it's really important to know that this fee is completely waived for veterans who have a service-connected disability. And finally, our fourth path is the USDA loan. Now, this one is pretty specialized. It comes from the Department of Agriculture, and it was created for one very specific reason: to help people buy homes in designated rural and suburban areas of the country. Just like the VA loan, a USDA loan lets you buy a home with zero down payment, 100% financing. But there are a couple of big hurdles you have to clear. First, the house itself has to be in an eligible area, which you can look up on their website. And second, your total household income can't be more than 115% of the median income for that area. Okay, you've done your homework, you've figured out your budget, you've picked a loan path. Now it's time to run the application gauntlet and make this thing official. This thing might look a little intimidating, but I promise it's not as scary as it looks. Pretty much every single lender in the US uses the exact same form. It's called the Uniform Residential Loan Application, or Form 10-3 for short. This is just where you officially put down all that information about your income, your assets, and your debts that we've already been talking about. And for our last section, let's quickly go over the rules of the road. There are a few major federal laws out there that were specifically designed to protect you during this process. And just knowing what they are is a huge confidence booster. The two big ones you'll hear about are TILA and RESPA. Here's the easiest way to remember them. Think of TILA, the Truth in Lending Act, as being all about the loan itself. It makes sure you know the true cost of borrowing money. Then there's RESPA, the Real Estate Settlement Procedures Act, which is all about the closing. It makes sure all your settlement fees are spelled out clearly. So TILA is for the deal, and RESPA is for the closing table. And there you have it. You see, the path to getting a mortgage is really just built on a foundation of rules and numbers, from DTI to LTV to the 4Cs. But the real magic happens when you understand how it all works, because that knowledge is what transforms you from just a hopeful buyer into an empowered owner. So, looking back on everything we've covered, what was the one thing that surprised you the most?